these currencies, if these other countries, as they see their currency start to collapse and inflate away and their exchange rates blowing out, they will start to look for a new reserve asset. And if they find one, which I believe they can find with Bitcoin, if they find one that's suitable and that can compete and defeat the US dollar in terms of global trade and liquidity and, store of value and all those things, then they no longer have need for any US dollars. And so then the dollar index will finally crash and we'll see a whipsaw back down, and that will cause the extreme inflation in the US. And so the end game is essentially, right, all fiats collapse into dollars and then all dollars into Bitcoin.
Today's guest is Roberto Rios, better known to many as the Peruvian Bull, a Spanish-American scholar, researcher, and educator whose work dives deep into the fault lines of our global financial system. Born and raised in Seattle, Roberto graduated magna cum laude in finance, economics, and entrepreneurship, and went on to study across South America before continuing his research at the London School of Economics. He worked in private equity and fintech before going all in into Bitcoin. He's best known as the author of The Dollar Endgame, a book and Substack that have become essential reading for anyone trying to understand the unraveling of our monetary system. Through nearly a decade of research, Roberto has traced how decades of easy money, spiraling debt, and monetary manipulation have brought us to a breaking point, a moment that could redefine the very foundation of global finance. Before we dive in, if you're new to the initiation, I'd really encourage you to go back and listen to the first 9 episodes. They form the foundation of this whole journey. That first season traces the arc of our time, from the breakdown of the old systems to the breakthroughs that point towards humanity's next stage of evolution. It's the core thesis behind everything we explore on the show, and it'll give you the context for today's conversation. So, welcome back to the initiation. Today with Peruvian Bull, a infamous Twitter personality in the Bitcoin space, and author of The Dollar Endgame, a book that I really enjoyed reading a while back. And today we're going to dive into monetary theory, Bitcoin, fiat currency, and just trying to really understand the bigger landscape and why our monetary system is broken and where it could go from there and what might be happening over the next years or decades, as well as covering what the potential other alternative could look like. So with all that said, let's dive right in. And I would love to understand what your take is on the current monetary system, where we are, why it is broken, and take us through sort of the building blocks and mental models and concepts to really understand this from first principles.
Sure. Thanks for that introduction. I've been researching and writing macroeconomics and finance and monetary history for researching about like 8 years now, and writing 4 years, 5 years in like a more, I guess you could say, formal or professional capacity. But really, in all my research, I found just a few themes that seem to be the most important undercurrents that are affecting the monetary system that exists today, right? And the first one is something called Triffin's dilemma. So for people who are not familiar with macro or with Triffin's dilemma in general, in February 1960, this Belgian-American economist came in front of Congress and warned essentially that the Bretton Woods monetary order, right, the post-war U.S.-led basically gold-backed dollar order, would be in serious threat due to this issue of external demand for U.S. dollars. So what Triffin pointed out is that, as the global reserve currency, the U.S. is responsible for supplying enough dollars to the rest of the world to fund global trade, to serve as foreign exchange reserves, to settle debts and international loans, right? For a plethora of reasons. And those dollars that need to flow out basically ensure like this constant pull of liquidity from the U.S., of dollar liquidity. And what he said is that we have this dilemma, we have this choice, right? We either choose to supply that liquidity with dollars, we print the dollars needed and export them abroad via trade imbalances or current account deficits to give the rest of the world enough dollars to fund their needs, or we don't. And the dilemma is, if we don't, ironically, we basically collapse the global monetary order as we know it, because in 1960 we're under Bretton Woods, and the entire global system is reliant upon a increasing spout of U.S. dollars flowing out into the global economy and allowing them to trade. And if we decide, okay, well, we don't want a global recession or a global depression and a freezing of international trade and a freezing of international capital flows, well, then the U.S. is going to be forced to print a lot of dollars. And if the rest of the world grows fast enough, which they did, obviously, in the wake of World War II and as the rest of the world globalized and started to industrialize, the U.S. has to print more money than is justified by their $35 an ounce peg. And what Triffin said is that eventually that will break, right? They'll break the global monetary system as we know it. And he was proven right. 11 years later, we exit the gold window. Nixon breaks the link, to redeem gold due to the French and others redeeming mass amounts of their U.S. dollar holdings for physical gold. And the rest of the next 50, 60 years is kind of like the downstream effects of that decision, right? With gold no longer being the anchor point for any currency globally, it means that now the global reserve asset has shifted to U.S. treasuries, so shifted to debt. And what that means is that all these foreign countries that earn in dollars as they have trade surpluses with the U.S. or as they have trade surpluses with other countries that have surpluses with the U.S., as they all accumulate these dollar reserves, they recycle them back into U.S. debt, right, or U.S. equity markets. And so that creates this, you could call it like a milkshake effect, right? Like Brent Johnson says, or a liquidity drain or monetary event horizon or financial gravity effect that just continually sucks all this capital into the U.S. and away from the rest of the world, because all these excess U.S. dollars show up in German banks, show up in Pakistani oil suppliers and Indian textile manufacturers and Japanese auto manufacturers, and they all want to earn a yield on these excess dollars. And the best place to earn a yield, obviously, is U.S. domestic equity and capital markets. And so this has meant that U.S. markets have outperformed the rest of the world by a large margin for the last 30, 40, 50 years. Now, the problem becomes, right, when we start to see an unwind of this structure. What happens when we lose global reserve currency status? What happens if the dollar is no longer used as the main medium of exchange for international trade? What happens when these countries realize that the treasuries that they have been hoarding as a result of their dollar surpluses no longer hold value, and they decide to use something else like Bitcoin? That's kind of what my book aims to explore, and what I was trying to get at in the end there is that the actual end result of this system is catastrophic, right? And we've always known that. We've always known that these debt-based monetary systems, because of the nature of interest and compounding, effects of percent gains every single year on the debt, as well as like just time and the exponential effects of that these systems are terminal, and that they require ever increasing amounts of money to keep them humming. But the U.S. is in a unique situation where, in the global monetary disorder or disintegration or whatever you want to call it, the U.S. initially will come out on top, and they still are, right? We've seen crises in the pound and the yen and the euro in the last 2 or 3 years. We've seen central banks do interventions like the Bank of Japan has in their currency market, or the Bank of England switching and doing, QE, emergency QE during the gilt crisis in September 2022. And the U.S. has kind of been able to have its cake and eat it too. But that day eventually will end. And when it ends, at the end of a long road of de-dollarization and monetary reshuffling, the U.S. will face its reckoning. And that will be a very, very dark day, because all these foreigners will no longer have need for these U.S. dollar assets, right? They they can sell them and buy some other reserve currency. And that means that U.S. equity markets will fall, U.S. bonds will fall, and likely the Fed will be forced to print money if they want to keep the bubble inflated. And that just means more QE, more debasement, and more inflation here at home. And so that's, kind of a scary scenario to envision, but it's important to understand that this structure has meant that basically no reserve currency has lasted more than about 80 years. The average lifespan is 78 years, and the average lifespan of a fiat currency is about 22 years. So while reserve currencies are able to buy time for their prospective fiats, they're not able to live forever.
Wow, that was such a good sort of overview of this core theme of Triffin's dilemma. And just to come back to that dynamic just in a little bit more detail, I think one of the consequences of the Triffin's dilemma is that, as you said, the US needs to export dollars to be the global reserve currency and to supply the world with dollars. But it also means that they have to import more goods than that they export, right? And so that hollows out their internal industry, their domestic industry, which, at the beginning was kind of, 60s, 70s was kind of still fine. But now over the last, especially 20 years, last 10 years in particular, has become more acute. And especially I think, first Trump presidency, but also now the second Trump presidency is potentially a result of Triffin's dilemma playing itself out, where the Midwest or the Rust Belt seeing more and more unemployment, more and more issues with drug abuse, etc. And now Trump is in power and is actually facing the fruits of Triffin's dilemma. Would you agree with that kind of characterization?
Absolutely. Yeah. And so I've actually was pointing this out on Twitter the other day, right? Like that, those are the ill effects of this problem, right? You have the benefit of the U.S. receiving a constant bid for their equity and bond markets in the terms of foreigners wanting to buy our assets to recycle their dollar surpluses. So that's great for Wall Street. It's great for Washington. It's great for U.S. corporates who can export their manufacturing base overseas and basically benefit from an arbitration in labor costs. But that hollows out and destroys the domestic American economy in the long term. And that's the reason why, very sadly, that drug overdose deaths have now overtaken combat deaths for the United States. So like we've lost more than 400,000 people since 2010 to drug overdoses, and that's more than all the soldiers we lost in World War II. So this is like a huge problem. And the deindustrialization scale is also quite shocking. The only thing comparable is, post World War I Germany or post World War I France in terms of a loss of industrial manufacturing power. Like that's how bad our manufacturing sector has been hit. We used to be around like a 60%, 65% manufacturing based economy in the 1950s and 60s, and now we're about 14%. And so that equates to an 80% loss of manufacturing power in just 50 years. And so essentially it's almost as if we've been through a war in the sense of the human cost as well as the economic cost of this dilemma. And like you said, this cannot happen forever, and it's responsible for the populist movements that have fueled Trump, that have fueled the Republican Party, even fueled candidates like Bernie Sanders, right, on the far left and the far right. People have responded to this economic catastrophe by pushing more and more radical political views on either end of the spectrum. And I don't see any reason for that to stop until the system meaningfully changes.
Right. And so where are we now in terms of that bigger cycle? And what is Trump trying to achieve with his tariffs that he's trying to impose on the rest of the world?
Sure. So where we are now is a very interesting, I would say we're in the middle of the reshuffling. We're still not towards the end game, right? The actual like last days, and where we'll see massive currency market volatility and central banks panicking and doing QE or doing QT or hedge funds and banks collapsing left and right. But we're at a stage where nation states and even foreign central banks and foreign private wealth funds are taking strategic moves to get ready for a change in the global monetary order. So the first place you can see this arising is there's a chart, and I actually have it in the book, I believe, of foreign ownership of U.S. Treasuries as reported by the Federal Reserve. And you can see that from 2008 to 2015, there's a huge increase, about $7 trillion worth of increase for that period, basically funding 71% of our net treasury issuance for that, that 8-year period or so. And that meant that foreign central banks and foreigners in general were buying the lion's share of the debt that we were creating in order to fund, the bailouts, the TARP programs, the TAMP programs, increased unemployment, all the stuff, the war in Afghanistan and Iraq, all the stuff that the U.S. was doing. The Chinese and the Japanese and others, the Germans included, were all funding this basically because they had such an entrenched need for U.S. U.S. yield for actual returns on their U.S. dollars. And that started to shift in 2015. And it especially started to shift after 2018, 2020 when COVID-19 hit. And the Fed, the Fed had to respond to this massive wave of treasury issuance, and they had to do QE. And they expected the rest of the world to buy on net a ton more treasuries along with the Fed, and they didn't. So that sent a shockwave through the through the monetary elite circles and made them realize that foreign central banks, foreign governments are no longer on net going to be really funding the U.S. going forward because it's not a winning deal for them anymore, right? Inflation in the U.S. is high. We have higher rates. If you own 30-year bonds and the Fed hikes rates to 7-8%, you've lost half the value of your bond almost. And so it's not a winning proposition anymore to be buying U.S. Treasuries and to park your money there for the long term. And so foreigners are no longer doing that. And that means that the Fed has now shifted to be the primary funder of deficits, right? They're the ones buying a lot of the debt and funding our government to allow us to continue to spend and borrow and do whatever other government programs we want to do. And
pension funds as well, a lot, right? In the
yeah,
US.
yeah. And pension funds can buy treasury bonds, but they have limited balance sheets, right? They don't have the only one that has an infinite balance sheet is the Federal Reserve, is a central bank. And
Yeah.
if foreign central banks with their infinite balance sheets don't want to buy treasuries, then the only one really left for us is the Fed, and then obviously our domestic commercial and maybe some private wealth funds, sovereign wealth funds from other countries, wealthy people. But again, that game will eventually run out. That game of musical chairs, they'll eventually run out of chairs to dance around. So what that means is that we've been in this transition period where governments are now looking for slowly a new reserve currency asset, or maybe just getting ready for a shift to a new one. And so you can see in the massive purchases of gold from global central banks. So the Polish, right, the Indians, the Germans even they've been
Russia,
repatriating gold.
China.
Yeah.
Yeah.
China has been doing it very aggressively. A lot of countries have been buying huge amounts of gold in order to shore up their gold reserves. I think Poland has got like another $202 billion worth of gold last year, and 2024 was the largest increase for global central bank gold reserves on record. The first quarter broke all other quarters by almost like 60 or 70%. So huge increase. And then we can see obviously now in the gold price marching steadily upwards to 3,300, 3,500, 4,000 an ounce is a clear sign that people are getting ready for a monetary shift. And so that dual nature of not buying treasuries and instead shifting their reserves to gold or to other assets is clear that people are getting ready for this change in the system.
Yeah, so many questions come up. I mean, I still want to double click on your perspective on what Trump is trying to pursue now. In a way, he tries to remain global reserve currency and boost its own domestic industry via the tariffs. So where do you see this going?
Yeah, Trump wants to have his cake and eat it too, right? And who
Yeah.
doesn't? The problem is, again, there are benefits to being the global reserve currency. Like, no one is disputing that. If you if you own the global reserve currency, you get access to essentially every bank in the world that has to do business with your money, and that means you can censor people, you can impose sanctions, you can blacklist, you can strong arm, you can essentially move money around much more easily because you have control of the SWIFT international banking routing system. So it's not an easy lever that anyone wants to give up. And so Trump is trying to thread this needle between the domestic population voter base that wants basically more trade protectionism, more reshoring of manufacturing, more jobs and opportunities to come back to the U.S., and the global system that requires the export of dollars, right? And to be fair, we could export dollars. There are other ways to export dollars. You can do, financial agreements. You can do a staged devaluation. You can do what are called swap lines with other global central banks. There's other things you can do, but really, what's been easiest is just the trade imbalance, right? Because the other side of a trade for goods or services is dollars, and so if you have a trade deficit, that means you have a dollar surplus, meaning you're a dollar exporter. So we are a dollar exporter. We are funding the global economy on net. And so Trump doesn't want to give that up, but he also wants to thread that needle at the same time. So that's why he's been trying to appease his voter base and trying to push these tariffs on the rest of the world, and especially China, who he views as the main antagonist in this story. And he's not wrong. Again, China has swallowed up a large portion, over 60% of the excess U.S. manufacturing that has been moved overseas. And China has benefited immensely from this. It's allowed them to basically urbanize, industrialize, bring up the standard of living and the overall GDP per capita of their population, and allowed them to kind of enter the 21st century on a much stronger foot. But the artificially weak currencies of the Chinese, the Koreans, the Japanese, those especially Southeast Asian countries have contributed to this problem, and Trump has embarked on this journey to fight them, right? And I think this Liberation Day fiasco, right, where he announced huge tariffs and then China escalated and then he escalated again and they got to 200%, 250% tariff rates, right, insane rates, it was all a bravado move of him showing his cards, right, so to speak, in the poker table, like trying to say, hey, I hold all the best cards. I hold a royal flush. You guys can't do anything to me. But to his dismay, he found out that that's not the case, right, because we saw equity markets correct very quickly. We saw credit spreads blow out. The 20-year and the 30-year bond hit 5%, right? So in very short order, equities and markets started to correct because you can't unwind the global monetary system without unwinding all of the trades that have been put on as a result of it. And a lot of those trades are long U.S. dollar assets, long U.S. equities, long U.S. bonds. So when you reverse that process, when you start to cut off liquidity to the rest of the world, well, they go out and they raise liquidity. And what do they raise liquidity in? The assets that they own, which is U.S. dollar assets, which is equities and bonds. So you can't unwind this system without a severe contraction in U.S. equity prices. And that's what Trump realized, and that's why they had to backtrack so quickly, because they didn't understand the intensity or like the depth of the impact that this Triffin's dilemma, dollar recycling loop has had on the American markets for the last 20 or 30 years.
Yeah. Yeah, I heard that the administration actually, I don't know if it was Scott Bessent, but some people actually wrote papers on the Triffin's dilemma. But it seems like, as you just said, even then they were blindsided by the intensity and the strength of that dynamic.
Yeah, exactly. And I'm not surprised. Again, it's hard to grasp, right? It's easy to think and to fall, especially as an American. I'm an American. I was born here. Obviously, I don't, don't sound like I have an accent. I was educated in university in the West Coast, and we're raised to believe in American exceptionalism from birth, right? You're told that America is the greatest country in the world, that everything we touch turns to gold. Our equity markets are the best. Our bond market is the best. Our military is the best. Our food is the best. Our healthcare, everything. And so it's really easy to fall into this belief that our equity markets are so much higher because we're just so much more innovative or so much smarter. The Germans and, the South Africans are just dumb and we're the brilliant ones, right? And that's not the case, right? It's obviously that the structure of this system has enforced US dollar hegemony and enforced higher US equity prices structurally for decades.
Yeah. So you mentioned earlier, foreign buyers are dwindling. So what happens if the Fed steps in as the buyer of last resort? So it looks like, the image that I have. You have the debt that is usually sold off elsewhere now is being sold to the own central bank. So what does that trigger then going forward?
Sure. So I'll start this with actually a funny anecdote. So, do you remember in 2011 when the Fed was doing their first few waves of QE, the gold bugs going on television and proclaiming that it was the end of the world? Were you around for that? Like
I,
Peter
I
Schiff?
wasn't really in financial markets back then, but yeah, I heard that from tales, but I wasn't around then.
Okay. Yeah. So right after the first waves of QE, because QE was a new phenomenon, right? This was
Yeah.
actually it's a monetary invention by the Bank of Japan in 2001, but it was adopted by the rest of the world in 2008, 2009, 2010. And it essentially meant the creation of these things called bank reserves, which is basically money for a financial institution. So it's not cash that you or I can trade for any real goods or services, but it's money only held on a bank balance sheet that's apportioned at a Federal Reserve bank, which is basically part of a massive SQL ledger that the Federal Reserve itself holds that denominates everyone's reserve balances and overall liquidity levels throughout the entire financial system. And so in the aftermath of 2011, everyone was calling for hyperinflation and everyone was calling for this basically a catastrophic melt up in prices and that we were going to be seeing shortages in this apocalyptic doomsday scenario, and nothing came of it, right? We saw mitigated inflation or muted inflation for the entire decade. So they all seemed like they were wrong. And so people incorrectly wrote off all the gold bugs and called them complete loonies because they had been so off on their prediction. And the gold bugs were, let's say, half right. And in macro, if you're half right, you're wrong. And
You're
so
wrong.
that's
Yeah.
it's a problem. But they were half right in the sense that the Federal Reserve was creating money. It just wasn't money in the way that everyone else thinks of money, and not the way that even they thought of as money. These settlement balances or these bank reserves flood into the financial system, and they do cause inflation, but they cause financial inflation. So they inflate financial assets, they inflate bonds, they inflate stocks, they inflate crypto. And so that meant that since 2010, 2011, for the last, we've had a 35-year bull market in the United States. 70% of the returns of the bull market have happened since 2010. 70% in just the last 15 years. So the lion's share of the move has happened because of the QE. Now, the way that this monetary, inflation that's trapped in the financial system can get out of the financial system and into the real economy is through two ways: bank lending and fiscal deficits. So when banks lend, they create deposits, right? And they create a liability, which is a loan. So they would give you or me a loan for $10,000 to buy a car. And that creates a new deposit out of thin air, right? Money is literally lent into existence. That means the money supply increases. So, but it does so obviously at a slow rate because the banks, they have limits to how many customers they can lend to, how many people actually want or need the money, how many people can pay it back. And so the money supply steadily inflates at, let's say 2, 3, 4% a year.
Yeah.
When the federal government runs into massive deficits and the central bank is running QE at the same time, you get this toxic mix where the central bank creates a bank reserve, right? That's cash. It goes out into the financial system. It's flowing around. And the federal government goes out and they borrow money. So they issue a bond. That bond gets sold to a primary dealer, which is a commercial bank. And that commercial bank, that primary dealer, buys that bond with a bank reserve. So you have the Fed over here creating a bank reserve. They give it to the commercial bank. The commercial bank gives the bank reserve to the Treasury. And now the Treasury has a bank reserve. And the problem is, obviously, I mean, structurally, they need to spend this, the government needs to spend this money in the real economy. They need to spend it on infrastructure, on, military, on social services, on whatever they want to do, beanie babies, whatever it is. They need to go out and spend that in the real world. So the Federal Reserve gave the government, and every central bank is like this, they give the government account, which is in the US is called the TGA. I'm not sure what's called in Europe or the rest of the world, but they give this account a designation, which means that whatever bank reserve goes into this account becomes a bank deposit when they spend it out. So again, it transitions from base money, M0, to M2 with the flick of a button. And you can see why that's necessary because, again, the government needs to spend the money in the real economy, not just on buying stocks or bonds. They need to actually spend it. So this needs to be bank reserves. But what that means is that when COVID happened and there was another wave of QE and all the gold bugs and Austrians came out and said, we're going to see massive inflation, everyone thought they were crazy. They ended up being right because inflation is a result of QE plus fiscal deficits. You need to have both in functioning at the same time for the excess money created by the Fed to flow out into the real economy and then to cause broad price inflation. And so that's exactly what happened. We saw 8-9% inflation in the US. We saw similar levels in the Eurozone. We saw increased, obviously, inflation in Japan and China. And basically like a global inflationary wave because all central banks were doing this. They were all running deficits to combat COVID-19 lockdowns. And they were all, accommodating in terms of their monetary policy. They were all easing. So when you have a global easing cycle paired with global deficits, that means more inflation. And so going forward, that with structurally high deficits that we have in the US of $2 trillion a year, that means if the Fed restarts QE again, inflation is going to roar its head again because it's going to people are going to see the increase in broad money supply in the M2 money supply in the bank deposits that will just flood out all other all other prices for demand. So it will mean that prices will rise much more. And so unless the US can fix that deficit problem, we're not fixing the inflation problem anytime soon.
Right. And then that's where the sort of snake bites its own tail, right? Because you can't really fix the deficit problem sustainably because you would have to either have higher taxes or lower expenses, and both is politically really tough. And on top of it, even if you do that, it will contract the economy most likely, which again will exacerbate the deficit. Is that right?
Exactly. Yeah, there's no way out. Like this is what I've said with my monetary event horizon or financial gravity piece. Like there is no way out. Anything they do makes it worse at this point. So GDP is also, obviously a flawed measure. I wrote about this in the addendum in my book. Not sure if you read the addendum in like the Q&A, but I had a bunch of questions from Reddit and from Twitter, people like arguing with me, and I was like, look, guys, GDP is calculated as government spending plus consumer spending plus investments, plus or minus exports, imports. So it's a very simple equation. If you reduce government spending, all of the things being equal, you reduce GDP. So
Of course, yeah.
in Europe or in the US where the government is more than 20% of the GDP, if you cut government spending, you cause a 10% recession immediately.
Yeah.
No questions asked.
Yeah. So, actually getting back to your book's main thesis, people who haven't read the book, it's that the roads mostly lead to either a massive deflationary event or then hyperinflation. And obviously governments will try to avoid a deflationary event. And so it most likely will end up being a hyperinflationary event. Take us through the sort of potential steps, how this could unfold over the next coming years.
Sure. So in the book, I try to lay out that the way and the path of the monetary collapse is going to be much different than people think, right? Most people, especially the gold bugs, have been claiming for years on Twitter that the global monetary system melts down with a weaker dollar first, and that's actually wrong. The dollar index serves as a barometer for global liquidity. So if it's higher, that means that actually other countries are needing more dollars, which means they're selling their currencies and they're buying dollars, which strengthens the dollar. But that's a sign of dollar stress, of liquidity stress, of people needing more money. And so, you know, periods of dollar strength against currencies like the yen and the pound in September 2022, or against the yen in basically all of 2023 and 2024, are examples of basically liquidity crisis on their side, because they need the dollars to transact in global trade and to hold as settlement reserves and what have you. And so the way that the global system will melt down is going to be different than most people think. As the system starts to implode and as people start to deleverage, they will rush for liquidity for US dollars, which means they can sell US dollar assets, and which will impact our equity markets negatively, but they'll be buying US dollars to pay off their US dollar debts, which means our currency will strengthen considerably. So the U.S., as we enter this end game, the U.S. will see a much, much stronger dollar unless they coordinate to devalue it. And the rest of the world will start to have currency crises first before the U.S. does. So like we've already seen the early stages of this. Japan, Britain, the Eurozone, the euro almost broke parity to the dollar, or actually it did break parity to the dollar in 2022. And this will be retested. And again, this is not it's not a linear process. It won't just happen at one point. It'll bounce off resistance a few times for over a couple of years before it finally breaks lower. But as we go through this process, all other currencies will start to weaken considerably against the dollar, and the dollar will strengthen and strengthen and strengthen, and all these other currencies will have their own crises, while the dollar remains relatively strong and while the system is at least in limbo. But towards the ender or the later, parts of the end game, let's say, these currencies, if these other countries, as they see their currencies start to collapse and inflate away and their exchange rates blowing out, they will start to look for a new reserve asset. And if they find one, which I believe they can find with Bitcoin, if they find one that's suitable and that can compete and defeat the US dollar in terms of global trade and liquidity and, store of value and all those things, then they no longer have need for any US dollars. And so then the dollar index will finally crash and we'll see a whipsaw back down, and that will cause the extreme inflation in the US. And so the end game is essentially, right, all fiats collapse into dollars and then all dollars into Bitcoin, if I had to phrase it up in one sentence.
Wow. That's quite, reading your book was very enlightening because, especially in the Bitcoin space, you hear about sort of hyperinflation being on the horizon and, you study that kind of theory yourself. But that sort of explicit scenario that you're describing is unique to your thesis, or is this something that has developed among several people in the space?
No, there's obviously people. I mean, I'm probably the most hyperbolic on it. I'm the most sounding the alarm, like scared and worried about this happening because, of course, my thesis is Dollar Endgame. It sounds ominous because, in my opinion, the long-term view is, and they would agree. But no, Lynn Alden and Luke Gromen in
I
particular,
was
and
going to
even
say
Brent
those names,
Johnson,
yeah.
yeah, those three have been really writing and pounding the table on this for years. Obviously they've been viewing it as playing out much slower, but I think COVID, it really accelerated everyone's timeline, because if you were reading like I was, like Luke Gromen back in 2018, 2019, he was talking about this stuff happening, but it was like 15-year, 20-year time frame, far out in the future. The trend was going to happen slowly. Loss of treasury as a reserve asset was going to happen very slowly, but COVID really put a booster on things, and so it sped up this process because it forced all these central banks to ease so considerably.
Yeah. Yeah. So you mentioned earlier there's going to be these kind of, what I heard, sort of contractions and expansions of this trend. Mm-hmm. It reminds me of one of the themes of this podcast is kind of the metamorphosis or phase shift that our civilization might be going through. And in the metaphors that I'm using, for instance, whether it's the transformation of a nymph to a dragonfly or a caterpillar to a butterfly, there's interestingly, both of these species have many molts before the actual full transformation actually happens. And only when all the conditions are right, the hormones, the external factors, the environmental factors, then it goes into this chrysalis moment, and these species go through a complete phase shift. So, does that translate to how our monetary system might be going through this complete unraveling at some point?
Yeah, absolutely. We've seen these phase shifts happen in the last, like I said earlier, the last few decades. So, the first phase shift obviously was, the loss of Bretton Woods and the introduction of the total fiat reserve currency standard in 1971. Then we had, the Plaza Accords, you could call it Bretton Woods 2, with the staged dollar devaluation and kind of like using the U.S. Treasury as a global reserve asset, the U.S. Treasury bond. And that worked pretty well for quite a few years. And the process of deindustrialization of the U.S., offshoring of manufacturing, increased trade deficits, increased imports, all that stuff started to play out. And then we obviously had the start of this shift, this most recent shift in 2015, when global central banks started to not fund U.S. Treasury issuance on net. So they're not adding to their cash hoard, and some are actually actively decreasing their exposure to U.S. Treasuries. And so we're in this like I said earlier, this limbo of these other countries. They haven't decided to dump all their treasuries yet. We're still we're still in the early stages of, I could call it like this, say the second part. So we're still like 40% of the way through this process, but they've realized that they need to start diversifying their holdings. So that's why they started to buy gold. And that's why Trump and Bessent talking about a strategic Bitcoin reserve, or having the government issue dollars to buy Bitcoin, is so impactful, because that gets at the core of Triffin's dilemma and the overall problem with the global monetary system and with reserve currencies in general. None of them last more than 80 years, really. There's a few exceptions in the past, like the British pound, but most of them last about 80 years. And the way that they end, especially the way that this one will end, will be pretty catastrophic, like I said, because you have to unwind all these trades that have been put on, right? All these people bought U.S. dollar assets because they need yield on their U.S. dollars. Well, if they no longer earn U.S. dollars in terms of global trade, then they no longer need to recycle those dollars into the U.S. And that means the biggest marginal buyer of U.S. equities is going to be gone. And in fact, they're probably going to be sellers. So we're still in this transition phase, but the main signposts to look for are global central banks selling their treasury bonds, for global central banks buying gold, obviously, for the Fed having to increasingly buy our own treasury bonds. And also you can see it in, the treasury itself can do strategic, we could call it like stealth QE, where they could shift the issuance of their duration curve to the front end. So they could say, hey, look, like, we're trying to sell these 30-year bonds. Nobody wants them. Foreign central banks don't want them. There's no demand from private. We're just going to shift. Instead of selling 30-year bonds, we're going to reduce the amount of 30 years we'll sell, and we'll make up the difference by selling a bunch of bills or a bunch of short-term debt. And that's one solution, right? It will keep the engine running for longer, but that's what third world countries, that's what banana republics do. That's what Brazil and Argentina do, because those countries, they fund 80% within 1 year, maturity, because they can't find a debt, like a borrower or a lender, I should say, for longer than that. Nobody wants to give them money for more than a year because nobody trusts them. And why would
Yeah.
you? It's Brazil and Argentina. They're known for
Yeah.
devaluing their currencies. So,
Yeah.
if the U.S. and as the rest of the world continues to move towards this, singularity, you'll see more and more of this economic and financial stress start to push central banks and treasuries and governments to issue more and more on the short end, and to increasingly get rid of their treasuries and get into shorter and shorter duration assets.
Right. Just on something you mentioned earlier, that from your point of view, the way it could play out is actually a stronger and stronger dollar. Doesn't that oppose the mandate of at least this presidency, but also probably of future presidencies, of really strengthening U.S. exports via a cheaper dollar?
Yeah, it does, and that's why Besant, if you read some of his, the stuff he's put out, he's talked about, they wrote a whole paper just last month about trying to engineer a cheaper dollar, trying to engineer a weaker dollar, trying to find out ways to essentially create like what he calls the Mar-a-Lago Accords, which is a callback to the Plaza Accords of 1985, which was a strategic devaluation of the dollar against the 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 pound, the yen, and the Japanese or the German mark, right? So those talks are already in play, and obviously, like you said, they're contradictory to where the pressure is in the global monetary system, and that's why they have to thread this needle. That's why they have to essentially pressure Powell to lower rates, because higher rates increases the strength of your currency because it attracts more capital, and so the U.S. remaining at these high rates is counterproductive to the goals that they want to achieve. And so that's why Trump has been pressing Powell to step down or to lower rates immediately or to begin monetary accommodation, because he wants the weaker dollar. He wants more exports. He wants to stimulate growth more. And he is allowing, he knows that, inflation will eventually come back if he does this path, but it's acceptable because it's, what else are you going to do? Are you going to let the global monetary system collapse and lose dollar reserve status faster? No, they don't want to do that. So the only option is to extend the lifeline, right? To extend the runway. And so the way you do that is weaker dollar.
Yeah. And so the tremors and the forebodings are already there. Central banks buying lots of gold. Do you think central banks are getting Bitcoin as well as a concept and are starting to unofficially buy Bitcoin already?
I don't know if they're unofficially buying. I mean, I think it's very unlikely, unfortunately. I actually met a central banker of an African country. This was like a year and a half ago, and he was a very smart guy, but he had no idea about Bitcoin. He did not understand it, even from a conceptual point. He didn't understand why you would want or even need such a thing, because in his mind, fiat is money is credit, and credit is good, and their central bank issues the best credit in the world. So why would you need anything different? Why would you trust an individual or an institution or decentralized monetary system when you can just trust the central bank that has been in place for 50, 60, 70 years? And their cadre, their board is just full of academics who have been steeped in monetarism, in Keynesianism, and neo-Keynesianism. And so they've been indoctrinated essentially against any form of free market, free range money supply. And so most central banks are not going to be easy to convince, right? But what that means is that you have to approach this now from like the geopolitical standpoint. So if you get the U.S. to start accumulating Bitcoin and then have them publicly tell other central banks and other countries, hey, we know the U.S. dollar is not going to be reserve currency forever. We know that the U.S. Treasury is not going to be a reserve asset forever. We've started buying Bitcoin with our dollars. We're going to create a new global monetary system with Bitcoin as the global reserve currency and as the global trade currency. If you want to be part of this new system, you better start buying Bitcoin. Well, watch how fast the
game theory plays out.
The game theory plays out, and all these governments finally put their pressure on their central banks, be like, dude, what are you doing? Start to buy some Bitcoin. So yeah, I think it'll have to come from external forces. I really don't think that it will happen from within, just because of the institutionalized economic indoctrination that's gone on in those institutions.
If you had to make a bet on the sort of rough timeline of this happening, this unraveling happening, what would you say?
10 to 15 years. We're about, like I said, 40%, I would say, maybe 35% of the way through it. So we're well into the transition. It just, we need to see some more aggressive moves from nation states to start to adopt Bitcoin as a global reserve asset and as a global trade asset before we were able to conclusively say that we're in the end game. Because again, once Bitcoin is starting to be adopted as a global reserve asset, right, and you see sufficiently deep capital markets for Bitcoin, even bond, and people don't like to hear it, but debt markets for Bitcoin, borrowing in Bitcoin, lending in Bitcoin, etc. Until you see those really develop and get deep enough that a central bank can play around in them, it's going to be hard for the central banks to want to get in. And so it's kind of a chicken and egg scenario, right? It's like Bitcoin has to be big enough and liquid for the central banks to get in, but the central banks also, if they get in, then the market will be big enough and liquid enough for them to trade in. So it's kind of a catch-22. So I think it's a matter of which nation state jumps on this first, and it'll be a transition period because when the first nation states start getting in, and then the FOMO starts hitting, and then Bitcoin price hits $1 million, then $2 million a coin, then $3 million, you'll see nation states start to move to adopt it, right, as a store of value. But the very tail end of that will mean that, like I said, they'll no longer have need for their U.S. assets, U.S. treasuries, U.S. bonds, U.S. equities, or even their U.S. dollars eventually, right? As you move down the moneyness curve, the things that I would say all the financial instruments in the world are essentially some form of money, right? Especially with the advent of modern central banking. They've been monetized to a certain extent. So an equity is money because you can go out and sell it tomorrow for cash. It's very liquid. But the moneyness increases the shorter the duration the debt or the higher the liquidity of the stock. So, and also obviously the lower, you want lower volatility stuff. So the things that are losing moneyness first, or like being thought of as money, are the long 30-year, 20-year, and then the 10-year bonds. And so those are the ones that are first on the chopping block to die. But as we move through this transition, more and more debt to shorter and shorter duration will be laid off, meaning sold or gotten rid of somehow, and they'll raise cash, which is at the extreme, very highly, obviously the most liquid thing, and once they've accumulated enough cash, they'll start to create a strategy of what to do with it. And the best strategy, I think, is to buy Bitcoin because the global monetary system cannot run on the dollar forever. The system is designed to break, literally. And there's never been a fiat currency that's lasted forever, and much less a reserve currency.
Yeah, and even buying shitloads of gold feels very antiquated, right? Like to go back to a gold standard is technically, coordinationally really hard. Or do you see a transition period where we move from a dollar standard to a gold standard and then eventually to a Bitcoin standard?
I think so. People think that they're buying gold in order to reback their prospective currencies. I don't think that's the case at all. I think that what they're doing is they're buying gold because they know that in a global monetary reshuffle, gold is going to go up, right?
Yeah.
And so why would you? And it's a safe, like a store of value asset, right? It's been used for thousands of years as a hedge against inflation. It is a safe bet. And it's a way for the central banks to maintain their purchasing power against all other commodities and all other currencies, regardless of time or space. But you're right. The problem with gold is that, for one, you still run into the fractionalized reserve banking problem, right? You have 1 ounce of gold, and they create enough money for 10 ounces of paper gold. And so you just rehypothecate the gold over and over again, and then you run into the same problem of bank runs and financial crises that we've had for forever, since the dawn of industrial civilization. But the other problem with gold is that you can't really use it in international trade, right? Are we going to go back to are we going to send a ship every month to India full of gold reserves, and then they're going to send us back a bunch of computer chips and textiles and spices? Like, come on, this isn't the 1800s. And just on a functional level, like going to the store and bringing a block of gold and having a little shaver and a razor and like grinding off some gold dust onto a little plate and measuring it, it's not feasible. It's not feasible in our modern day and age. We live in a digital age. So, I don't believe that we're going to go into a modern version of the gold standard. Again, I think it's like a modified, you can think of it as like a modified transition where people use gold as like a store of value proxy to hold on to until they see what what's coming next. And I think the central banks are still heavily discounting the role that Bitcoin is going to play in the future monetary system. I think they just don't understand it, and they're not expecting it to be meaningfully important.
Yeah, and even if they were thinking that buying gold is probably equivalent of purchasing IBM, you never get fired for buying an IBM product instead of some other software company. So it's just too scary, I think, as you said, like for an organization staffed with thousands of academics to go into something like Bitcoin. Yeah. So, what do just to project into that future, let's say we do live in a Bitcoin standard. What does it look like, broad strokes, in terms of the global economy? Are there still central banks? What's the role of banks, etc.?
Sure. So I actually think there's a few different ways for this to play out, and I don't want to time myself or marry myself to any one conclusion, right? Because you could see some countries, especially the ones that are maybe more revolutionary in nature, like the United States, lead to a much more free market system, and other countries that are much more authoritarian, tyrannical, like the Chinese or the Japanese, lead to a much more top-down, almost like enforced approach, right? So for each country, I think it's going to play out slightly differently, but I think globally, you're right. I think we'll move to a Bitcoin standard, and Bitcoin will be used as the medium of exchange for global trade. Again, that won't happen until we see meaningful stabilization of Bitcoin at a very high price, as well as basically a breakdown in the current financial system. So, very high double-digit inflation, triple-digit inflation globally, almost across the entire world, and a breakdown in stock market prices in real terms, bond markets, pension funds, etc. And that will force the system to meaningfully change, right? It will cause enough revolutionary fervor to make things change. But there's a couple options. One option is the pure Bitcoin standard, which I think is the most, as Bitcoiners, like what we hope happens, right? All of the central banks, basically, the pitchforks and the fire is at their door. They all force a shutter. They all run to their bunkers or their private jets, and they all flee and they run away. And we essentially abolish central banking, and we abolish most of banking in general as it's normally thought of. And we just say we're going to use Bitcoin to transact for everything, and we'll create, lightning channels on businesses that will siphon off 10% of your sale for your coffee to the government as like a sales tax. And that's the way the government will earn Bitcoin. And then the government will use Bitcoin to spend and to fund their operations. And so the governments will get a lot smaller. The bloat of budgets will get a lot smaller, and there won't be a world of infinite debasement and debt. And I think that's like the most bullish scenario. But even in that scenario, right, like a lot of people are not ready to take full self-custody of their Bitcoin. And so I think you'll see custody solutions pop up everywhere, where there'll be exchanges or banks or whoever saying, we'll take your Bitcoin, we'll issue you an IOU, and you can go use the IOU and spend it somewhere. And again, so this will be like a smaller scale model of the fractional reserve banking scam, but it luckily will be much more enforceable, because like instead of having the gold in a vault where you don't know where it is and you can't audit it and they can lie to you, they can't lie to you. They can have a public address and you say, "Oh, I know you issued too many, Bitcoin IOUs for the Bitcoin you have." So it'll be much better. This is like the best case scenario. The next scenario, right, is, which I would call the middle ground, is you could call it like a mixed Bitcoin fiat situation, where the government steps in and says, okay, Bitcoin is legal tender, but most people don't know how to custody it. Most people, like if you want to take self-custody and use it to spend at locations, you can, but we're going to create our own fiat currency that's backed by Bitcoin, and it'll be redeemable for 1,000 sats each dollar or whatever it is. It'll be fixed. And so then again, the goal is to not allow the supply to inflate too much. And luckily, then we'll still have Bitcoin as a medium of exchange, so we can use it as a check and balance on the government printing too many dollars as would be justified by their Bitcoin holdings. And then, so that's like the middle ground, which actually I think is probably pretty likely. And then the worst case scenario is like CBDCs. So the government goes full tyrannical, in, let's say globally or just in your respective country. They go full tyrannical. They go full 1984. They censor everybody. They go after the exchanges. They go after the wealthy Bitcoiners. If you have a cold storage wallet, they try to arrest you and seize your Bitcoin. And they just say, we're implementing CBDCs across the entire world, and everyone has to use this and get a chip implanted in their hand and use that to pay for all their goods and services. And that's like the most negative outcome that we could imagine from this. But I think there's enough revolutionary spirit in most countries that would resist that and would prevent that from happening. But we'll have to wait and see. Yeah. So I've thought about this a lot, right? Because a lot of Bitcoiners are extremely, I would even say maybe hyperbolic or overly exuberant about a Bitcoin standard. And they are right. Like, it's going to solve a lot of problems. The rampant inflation, the rampant wars and reckless spending and government waste will now be a thing of the past, because again, the government will be forced to kind of be constrained within certain bounds, because it won't be easy to earn money in real sense. You have to tax the population, which is unpopular, or you have to borrow. And if you're going to borrow Bitcoin and pay, the market's going to demand 8% rates, 9% rates. And the government, there's only a little bit of debt the government can borrow at those rates before it starts to run into an issue. So, and also most people won't even want to probably lend Bitcoin to a government. So you'll just see a much, much smaller government, much, much smaller fiscal and treasury authority than has been in the past. I think like there'll be a huge, obviously there'll be a huge boom in energy industries, in especially natural gas, in shale, and a lot of, when you think of energy, think of all the revolutions we've had in the last 15 years that has allowed us to create energy in like far off places that are disconnected from the grid. Those kinds of energy sources, which are, previously they would have to burn flare gas or whatever at the natural gas well, because they just can't ship all of it through a pipe. There's just too much. It fluctuates. You can now burn that, create energy, and then use that energy to power Bitcoin miners. And now you have a source of income as a company. And so you would see, I think, a boom in energy production and actually a lowering of energy prices, because all these energy producers will be building out more and more production, because they can use the production to mine Bitcoin. It's like printing money. So it's like, why wouldn't you join this in this rat race to produce more energy? So you'd see huge amounts of energy produced, and a fall in the cost of energy marginally. And obviously, like we said, less wars, less overall corruption. All these things would become much, much more difficult to do. And there are Bitcoiners who say like this will be impossible, and I do not think that that's true. There will still be wars. There will still be corruption. There'll still be people trying to scam people out of their Bitcoin. There'll still be, Saifedean talked about in his book, like there won't be any bad bosses. And when I read that, I just had to chuckle, because I was like, no, there'll still be bad bosses. Human nature will still exist, but this will put the natural physical limits on human nature that we've had for thousands of years back onto people, which will help to restabilize our system. So, that's what I think, but I'm sure you probably have your own opinions. I wonder what. Yeah, absolutely. I think you're right on the time preferencing, especially, right? Like, we're going to see a boom in real production, real real capital creation, real conservation of money. You're going to see, even things down to the architecture, right? We've talked about this. Like, there's been Bitcoiners pointed out, like, we've seen a complete collapse in the quality of our architecture ever since the fiat age began, because people are no longer planning for a future, because you don't plan for the future because your money's going to be devalued. You plan for now. You borrow as much money right now and gamble it on the stock market or gamble it in the bond market. And so a return to sound money will mean, likely a fixing of a lot of the agricultural and architectural and just social problems that we see today, right? So I think you're absolutely spot on about that. I'm excited for that future. I really hope that that's the one that plays out. Of course. Thanks so much for having me. I really appreciate you having me on. Bye.